The most profitable decision I ever made in the market was to do absolutely nothing. Let that sink in for a second. No buy button, no sell button, no hedge, no scalp, no at least I tried. Just me, my screens, and a deliberate choice to stay flat while everything in my body was screaming, "You're missing it." When I look back at Jesse Livermore's career, the wins, the wipeouts, the comebacks, there's a pattern most traders completely ignore. We obsess over his big scores, the panic of 1907, the crash of 1929, the massive wins that wrote his legend. But buried underneath those headline trades is a quieter, stranger truth. Livermore got rich not by trading more, but by learning when to not trade at all. What I call the do nothing rule. It sounds almost offensive to a trader's ego. We come to the market to act, to predict, to participate. Our entire identity gets tied to activity. I'm a trader, therefore I must be in trades. Flat feels like failure. Flat feels like we're not doing our job. Eventually, Livermore flipped that idea on its head. He started treating inaction as a weapon. To him, do nothing wasn't laziness, it was selective aggression. It meant refusing to rent his capital, his attention, and his emotional energy to second-rate opportunities. It meant standing aside when the tape was confused, when leadership was unclear, when the trend was young or dying, when his rules didn't all line up. In his world, and in mine now, cash isn't just a balance. Cash is a position. Being in cash means you're not wrong. You're not fighting the tape. You're not giving the market a cheap option on your emotions. You're waiting, letting conditions evolve, allowing bad setups to expose themselves without your money attached. Most traders never experience that kind of stillness. They wake up, fire up the platform, and immediately feel the subtle pressure. Today must count. Today I must find a trade. Today I must prove I'm a trader. So they force entries, they downgrade their standards, they take B and C level setups because the idea of doing nothing feels worse than losing money. Livermore lived that phase too. As a young speculator in the bucket shops, he chased every wiggle. He felt that same itch, that same need to always have skin in the game. But over time, he saw the same brutal math repeat. His biggest winners came from a handful of trades that he waited ages for. His largest drawdowns came from a flood of small, impulsive trades that added nothing but noise. He eventually realized the obvious, painful conclusion. It wasn't the bad market that ruined him. It was his inability to stay out of bad markets. And that's where the do-nothing rule really comes from. It's not some motivational slogan. It's a survival law. It's the recognition that your worst drawdowns rarely come from that one bad idea. They come from the 20 mediocre ideas you couldn't resist acting on because sitting still felt unbearable. I want you to think about your own trading for a moment. How many of your worst weeks were caused by one catastrophic trade? And how many were a slow bleed of little stabs, little pokes, little boredom trades you knew weren't your best? If you're honest, it's usually death by 1,000 cuts, not one sword. Comment hook. Before we go deeper, answer this in the comments. In the last month, how many days did you trade just because you felt you had to, not because your A+ setup appeared? Type forced days, and the number. No shame, just honesty. In this film, I want to take you inside the emotional storm behind this rule. Why doing nothing is so hard. Why your brain fights it. and why Livermore's entire edge depended on his ability to wait when everyone else was flinching. To really understand that, we need to walk into the inner battlefield, where your need to act collides with your need to survive. That's the paradox every trader lives with. If the market only pays the patient, why does it feel so painful to be patient? That's exactly what we'll unpack next. When I ask myself honestly why doing nothing feels so hard, it always comes back to this. My identity wants movement. The market, most of the time, rewards the opposite. That's the paradox we live inside as traders. On the one hand, you and I came here because we wanted freedom, financial, geographic, psychological. We didn't choose this path to sit on our hands, stare at charts, and go to bed flat every night. A part of us equates action with progress. If I'm in a trade, I'm working. If I'm flat, I'm wasting time. But the more you study the tape, the more you track your own results, the more uncomfortable truth you see. The market doesn't care how much you do. It only cares how often you're aligned with a real edge and a real opportunity. There's no loyalty bonus for being active. There's no salary for participation. All that matters is, when you chose to engage, were the odds quietly stacked in your favor, or were you just scratching an itch? Livermore ran headfirst into this paradox. He loved the game. He loved reading the tape, feeling the pulse of the crowd, sensing when something big was forming. But he noticed that the part of him that loved the feeling of trading was usually terrible at deciding when to trade. The instinct that said, "do something," almost never arrived at the same time as the truly great setups. So he began to see his own mind as two characters. One was the operator, methodical, patient, willing to wait weeks for a proper line of least resistance to appear. The other was the gambler, restless, bored, allergic to cash, always afraid of missing the next move. Here's the paradox in its sharpest form. The operator in you knows that most days are not worth touching. The gambler in you is terrified that if you don't touch today, you won't get where you want to go. Modern markets amplify this split. Every time you open your phone, you see someone posting a winning trade, a green P&L, a "look what I caught" screenshot. Your nervous system doesn't process the sample size or the risk. It just hears, "they're in, you're not." Sitting flat in that environment is not neutral. It feels like an attack on your self-worth. And this is where the do nothing rule becomes more than a tactic. It's a direct challenge to your ego's idea of work. It forces you to accept that real trading work looks very different from what your emotions want. Real work is studying the general market tone even if you don't place a single trade. Watching leaders and laggards rotate even if you never click buy that week. Letting setups fully form. Letting bases tighten. Levels test. Liquidity show up. Without trying to front-run every wiggle. Admitting that some sessions your only job is to observe and update your understanding, not to collect points. The paradox is cruel but simple. To become the kind of trader who can act decisively when it matters, you have to be the kind of person who can sit quietly when it doesn't. Livermore learned that the hard way. Every time he let the gambler run the show during bad conditions, he bought himself more psychological baggage to carry into the next real opportunity. So this inner conflict between the operator who's willing to wait and the gambler who needs constant action isn't a side issue, it is the issue. The do nothing rule is basically Livermore choosing which side of himself gets to drive. To see how dangerous it becomes when the gambler wins that argument too often, we need to go one layer deeper into the pattern that forms when you refuse to accept this paradox and keep forcing action anyway. That pattern is the psychological trap at the core of overtrading, the loop that makes you believe more trades means more progress, while quietly draining both your capital and your confidence. Section 2 left us with that split between the operator and the gambler. The part of me that knows I should wait, and the part that can't stand the silence. If I'm honest, it's not a 50-50 fight. Most of the time, the gambler walks into the room with way more momentum. That's how the real trap starts. The trap doesn't begin with a giant mistake. It begins with a tiny compromise. A day where the market is choppy, the leaders are tired, the indices are stuck in a range, and I tell myself, I'll just look for something small, a quick scalp, just to stay in rhythm. I open the platform with that thought already loaded. Find a trade. Not find an edge, not wait for alignment, just find something. My standards have quietly shifted. Instead of asking, is this A+, I'm asking, is this tradable enough to not feel useless today? That's the first coil of the trap. I take a setup that's okay. Maybe the structure isn't great. Maybe the volume is light. Maybe the broader market is out of sync with the direction. But I'm in. I feel active. For a few minutes, the discomfort of being flat is gone. And if that trade happens to work, even a little, I've just reinforced the worst possible lesson. It's fine to downgrade your standards. You still got paid. This is exactly the dynamic Livermore saw in himself. When he talked about overtrading, he wasn't just saying, I took too many trades. He meant he started to believe that the act of trading itself had value even when the quality didn't. The gambler inside him used small wins on bad trades as proof that the operator was too strict. But the market always comes to collect. The same loose standards that gave me a few easy wins now carry me, almost without thinking, into a string of mediocre positions. The environment hasn't really improved, but my activity has. More entries, more noise, more screen time, more emotional swings. Then conditions get just a little bit worse. A stuffed breakout here, a fake-out there, a sudden reversal on what should have worked. Because my setups weren't that strong to begin with, they can't withstand much turbulence. I start taking hits. Nothing catastrophic at first, just a steady leak. This is the second coil of the trap. Losses that feel too small to demand real change, but big enough to make me uncomfortable. Now the gambler has a new story. You're already down. You might as well trade more to make it back. So I do. Volume of trades goes up, quality goes down further. I start revenge trading in disguise, calling it opportunity, volatility, range trading, anything but what it is. Me trying to escape the feeling of being wrong by taking on more risk. The more I act, the less I see. Context shrinks to the last candle, the last minute, the last P&L swing. Livermore watched this same pattern swallow entire fortunes, including his own at times. He understood that overtrading isn't just too many trades, it's trading driven by emotional discomfort instead of clear opportunity. It's the slow-motion process of letting the gambler take the keys and locking the operator in the back seat. And here's the final twist of the trap. By the time a truly great opportunity appears, a trending tape, clean leadership, a perfect base, the trader caught in this loop is exhausted, psychologically bruised, capital reduced, confidence shaky. Now, when it's finally time to bet big with the operator's conviction, the gambler has already burned the resources on noise. That's the real cost of failing the do-nothing rule. It's not just the money lost on bad trades, it's the energy and clarity you no longer have when a Livermore-style opportunity finally shows up. To break that pattern, Livermore had to change how he saw inactivity itself. He had to stop treating doing nothing as a failure and start treating it as a decision that protected him from this spiral. In the next section, I want to step into his head directly, how he framed this rule for himself, how he justified it in a world full of movement, and how he turned silence into a strategic position instead of a psychological burden.
By the time you really see that spiral, lowering standards, getting rewarded for it, then leaking capital and energy, it becomes obvious why Livermore had to think differently about inactivity. If every forced trade is an invitation to that loop, then doing nothing stops being absence and starts being protection. That's exactly how he came to see it. He didn't imagine the market as some machine that needed constant feeding. He saw it as an environment that alternated between clarity and confusion. In clarity, the line of least resistance was obvious. Strong trends, clear leadership, constructive pullbacks, sponsored breakouts. In confusion, signals contradicted each other. Choppy ranges, failed breakouts, leaders losing momentum, headlines moving price more than structure did. Early in his career, he treated those confusing periods as something to fight through. Later, he treated them like bad weather. You don't argue with a storm, and you don't sail into it just because you're tired of being at the dock. You wait. That's the core of his do-nothing mentality. He accepted that there were entire stretches of time when his best move was not to play. Not because he was scared of risk, but because his style, his method, his edge, simply weren't suited to the tape in front of him. In those stretches, trading more didn't mean applying his skill, it meant betraying it. He also understood something we tend to ignore. The market has no obligation to offer you opportunity at the same pace you desire growth. Your financial goals, your monthly targets, your need to get ahead are completely irrelevant to the tape. When conditions aren't right, pressing harder doesn't bend reality. It just accelerates damage. So he made a mental inversion that most traders never make. A day with no trades in a bad tape equals a good day. A day with many trades in a bad tape, even if profitable, equals a dangerous day. From the outside, that looks backwards. From the inside of his experience, it was pure risk math. Every unnecessary trade in poor conditions multiplied the chance he'd be mentally and financially unready when real conditions returned. There was also ego in the mix, and he knew it. Sitting out means accepting that, for the moment, the market is more powerful than your need to participate. It means admitting, my will is not enough to create opportunity. That stings. For someone with Livermore's talent and reputation, it meant swallowing the idea that being a legendary operator didn't entitle him to daily action. Instead of resisting that, he folded it into his philosophy. He separated work from trading. Work was studying, observing, taking notes, watching how leaders behaved, mapping levels, sensing sentiment. Trading was execution under very specific conditions. Work could happen every day. Trading did not have to. That's why in his writings and the stories told about him, you see this recurrent theme. Long periods of watching and waiting, suddenly followed by decisive, concentrated action. The big moves, the famous campaigns, were the visible tip of an iceberg made mostly of stillness. In our world of constant noise, that perspective is even more radical. Platforms are built to keep you clicking. Feeds are built to keep you engaged. There's always another chart, another coin, another small cap about to explode. Through Livermore's eyes, most of that is just weather. Interesting, sometimes educational, but not necessarily tradable. Once you adopt his perspective, do nothing stops feeling like abandonment of the game and starts feeling like playing a longer game than everyone else. You're not trying to win today, you're trying to be intact and ready when a real opportunity justifies sticking your neck out. From that mindset, the next logical step is to see what this rule looks like when tested in real time. On a day where the itch to trade is strong, the noise is loud, and the only thing standing between you and the spiral is that quiet, uncomfortable choice to stay flat.
On paper, it's easy to say, bad tape, do nothing. In real time, it feels very different. One particular day burned that lesson into me in a way I couldn't forget. The backdrop was almost textbook confusion. The indexes had been whipping up and down for a week, no clean trend, just violent intraday swings. Breakouts that looked perfect in the morning were failing by lunch. The prior 2 days, I'd done the exact thing Livermore warned against, tried to be clever inside the chop. Small losses, small scratches, too much emotional noise for too little information gained. That morning, I opened my screens and saw the same fractured picture. Futures green, but on declining momentum. Key sectors out of sync with each other, leadership names stuck in the middle of their ranges. If I described this exact environment to you as a hypothetical and asked, should you be aggressive here? You'd probably say no without hesitation. But there's a difference between giving a good answer and living it with real money on standby. Then came the test. One of the high flyers from earlier in the month, call it Helios Tech, started moving pre-market on some upbeat news. My feed lit up. Helios gapping, finally waking up. This could be the one to break out of the chop. I pulled up the chart. It was gapping right into the same messy zone that had rejected it 3 times already. No base, no fresh leadership. Just a stock trying to stretch inside a bad backdrop. I could feel both voices firing at once. The operator, same foggy tape, same weak structure. This is exactly the kind of thing that's been chewing people up. The gambler, yeah, but what if this is the exception? What if this is how you make back those last 2 chopped up days? You really going to watch this go without you? In the past, that's all it would have taken. The combination of a familiar name, some news, and the fear of missing it would have pushed me into the trade. I wouldn't have called it that, of course. I'd wrap it in analysis, in context, in fancy language. But underneath, it would be the same impulse. I can't stand doing nothing anymore. This time, I did something different. I pushed my chair back from the desk. I literally folded my arms and asked myself one question that came straight out of Livermore's worldview. If I had no need to make money today, would I still take this trade in this tape? The honest answer was no. Not maybe, not if it pulls back, just no. So I stayed flat. I watched the open. Helios ripped higher for the first few minutes, just enough to make me feel like an idiot. Then the character shifted. The same volatility that had been dominating the indexes all week showed up here too. Wide bars, failed pushes, random wicks. Within an hour, the gap had been filled. By lunchtime, anyone had chased the excitement at the open was sitting in drawdown, telling themselves stories about weak hands and shakeouts. I didn't make a cent on that move, but I also didn't donate a cent. More importantly, I didn't feed the gambler. I walked away that day with the first real visceral proof that the do-nothing rule wasn't just theory, It had just paid me in money I didn't lose and in energy I didn't burn. That experience didn't magically fix my behavior, but it gave me something concrete, a memory of patience working in my favor even when it hurt in the moment. The real challenge came later, in a stretch where the tape stayed rough longer than my patience wanted it to be, and the temptation to abandon this rule showed up in a much uglier form. That's when the emotional low point around trading less really hit.
Section 5 ended on that Helios day. A small victory where I actually obeyed the do nothing rule and watched a messy move punish other people instead of me. But if I'm honest, that kind of clean reinforcement doesn't happen often. The real test of this rule came later, in a stretch where patience didn't feel rewarding at all. It felt like slow torture. The chop didn't go away after Helios. It lingered. Day after day, the indices faked one direction and reversed. Leaders couldn't sustain momentum. Breakouts either failed or went just far enough to suck you in before rolling over. From a structural point of view, the operator in me could see it clearly. This was not a forgiving market. This was the kind of tape where even good traders bleed. So I did what the newer version of me was supposed to do. I cut size way down, and many days I didn't trade at all. On paper, that was the right move. In practice, it started to eat at me. Every morning, the routine was the same. I'd scan, map levels, check leadership, and come to the same conclusion: nothing here is clean enough, and I'd stay flat. The first few days, that felt professional. By the second week, it started to feel like failure. I'd open social media and see people posting their wins, some real, some probably exaggerated. Crushed this reversal, perfect scalp in this range. You just have to adapt. Part of me started whispering, maybe you're not adaptable. Maybe you're hiding behind this do-nothing idea because you're scared. Maybe this rule is just an excuse. That was the emotional low point of this journey. Not a single catastrophic loss, but the growing suspicion that my discipline was actually holding me back. My P&L was basically flat. Everyone else, at least in the online illusion, seemed to be finding ways to extract money from the same chaos I was refusing to touch. The gambler used that against me. You've gone soft. You used to trade this stuff. You used to find edges in noise. Now you just sit and watch. One evening, after another flat day, I pulled up my trading journal, not because I wanted to, but because I felt cornered. I looked back over the previous months. The pattern was embarrassingly clear. My worst stretches didn't happen in strong trends. They happened in tapes exactly like the one I was in now. Choppy, headline-driven, with no clear leadership. And every time the damage came from the same behavior. I refused to accept that the best move was to do less. I compared two sets of weeks where I forced trades in this kind of environment, and weeks where I'd managed to stay mostly inactive. The difference wasn't subtle. The force-it weeks showed a messy cluster of small losses, frustration notes, late-night self-negotiations. The do-less weeks looked boring on the equity curve, but when a clean trend finally emerged afterward, my account and my head were both in shape to take advantage. Seeing that in cold numbers hurt, but it also broke something loose. I realized the low point I was feeling wasn't actually about the market. It was my ego mourning its old identity. I wasn't the always-in-the-action trader anymore. I wasn't the one who had a take on every wiggle. I was trying to become something quieter, more selective, more like the Livermore who waited through entire phases of the market just to strike hard in a handful of moments. That night, instead of telling myself this rule is holding you back, I tried a different question. What if this rule is the only thing standing between you and another slow bleed? That reframing didn't suddenly make waiting feel fun, but it did transform the way I saw my inaction. Flat days stopped being empty. They started to feel like deliberate choices, small acts of self-preservation that were buying me the right to be aggressive later. And that's exactly where Livermore's own turning point lived. After enough cycles of making and losing fortunes, he didn't just respect the do-nothing posture. He elevated it into a central rule in his playbook, a filter about when to trade at all, not just how. That's the breakthrough I want to unpack next. How, in his philosophy, doing nothing became as concrete and rule-bound as any entry or exit signal. By the time I'd stared at those journal pages and accepted that my ego was louder than my edge, I started to see why Livermore had to turn doing nothing into an actual rule, not just a vague idea. If it stayed a feeling, it would always lose to the urge to trade. So he did what he was best at. He turned experience into structure. For him, the breakthrough wasn't just sometimes sit out. It was more precise. I only trade when the tape, the trend, and the leadership all agree. When they don't, my default position is cash. That's the do-nothing rule in his language. Cash is not a waiting room. It's the base state. A trade is an exception that must be justified by the market, not by his mood. He used a few very clear filters to decide when to move out of that base state. First was the general market. If the overall trend was uncertain, whipsaws, overlapping bars, indecisive closes, he assumed that any apparent opportunity was more likely to be noise than signal. He didn't try to be the hero who figures out the range. He'd made that mistake before and paid for it. Second was leadership. In his best campaigns, there were always a few names clearly out in front. Stocks that were being accumulated, making new highs, pulling back constructively. When he couldn't identify those standouts, he didn't force it. A market without leadership, in his eyes, was a market that hadn't decided whose story it wanted to tell yet. Entering big before that decision was made was just volunteering to be part of the confusion. Third was price behavior around key levels. Livermore wasn't trading lines on a chart. He was trading the behavior of crowds around those lines. He wanted to see tests, retests, and then decisive breaks with volume. If instead he saw sloppy action, fake breaks, erratic volume, he took that as the tape telling him, this is not your kind of battlefield. The key insight is this. Any one of those filters failing was enough for him to do nothing. He didn't need the market to scream, danger in all caps. A murmur was enough. What changed in my own thinking, informed by his, was the order of operations. Before, I would start with, what can I trade today? After internalizing this rule, the first question became, does the environment deserve my capital today? Only if that answer was yes would I move forward to setups, entries, and tactics. It's a very different hierarchy. In the old hierarchy, the need to be active sits at the top, and the market is something to be wrestled into providing opportunity. In the Livermore hierarchy, the state of the market sits at the top, and your default stance is respect. The do-nothing rule is simply what respect looks like when conditions are muddy. For modern traders, this isn't just philosophy. It's a direct counter to the way our tools try to shape our behavior. Platforms are built to keep you clicking. Notifications are built to keep you reacting. A rule that says, I am flat unless A, B, and C are present, is a way of reclaiming your decisions from that constant stimulus. What Livermore understood, and what I'm still learning, is that discipline doesn't just live at the moment of entry. It lives in all the moments you choose not to enter. Without that, you're always one bad stretch away from undoing months of good work. With it, you start to see fewer trades, but each one feels like a conscious choice instead of a reflex. From here, the next step is obvious. How do we take this old-school do-nothing principle and make it usable in today's hyperactive markets? How do you build it into a modern trading life with screens, alerts, crypto, options, and social feeds constantly poking at your attention? What really changed things for me was when I stopped treating Livermore's Do Nothing Rule as something belonging to an older, slower market and started treating it as a direct answer to how hyperactive our environment is now. The principles are old, but the pressure to ignore them has never been stronger. Think about how we trade today. Screens everywhere, 24/7 products, crypto moving while you sleep, options expiring every few hours, phones buzzing with alerts and screenshots. If Livermore walked onto one of our trading floors or into one of our Discord rooms, he wouldn't say, "Now you must trade more." He'd probably say, "Now you must say no more often, or this machine will eat you alive." So I began mapping his filters straight onto modern tools. That first question, does the environment deserve my capital, can be answered faster than ever now. We have index futures, volatility indices, sector ETFs, breadth data, relative strength rankings at our fingertips. Instead of using that information to justify action, I started using it to justify waiting. If the S&P is in a clear, orderly uptrend, with breadth improving and leading sectors confirming, that's a green light to look for trades. If instead we're chopping sideways, breadth is weak, defensive sectors are leading, and volatility is elevated, that's a red or at best yellow light. In that environment, the do-nothing rule might mean only taking partial size on the very best intraday patterns, restricting myself to one or two tightly defined scalps, or simply declaring the day an observation-only day before the open. The same applies to different styles. If I'm day trading, the do-nothing rule means I don't have to find a trade every session. I can make my work scanning and journaling, then accept that today's best move might be prepping for tomorrow. If I'm swing trading, the rule becomes even more powerful. No new swing positions unless the weekly and daily trend agree, leaders are acting well, and my setups are breaking out of real bases, not just popping on headlines. With crypto, which trades nonstop, the rule might sound like this. Just because the market is always open doesn't mean I always have to be exposed. In practice, that means choosing time windows where I'm allowed to act and being flat outside them unless a truly exceptional setup appears. Without that, the 24/7 nature of the market turns into 24/7 emotional churn. Social media is another battlefield. I started to treat my feed the way Livermore treated the bucket shops, as noise that occasionally hints at where the crowd is trapped, not as a source of opportunity. If my entire desire to trade a product comes from a thread, a meme, or a screenshot, that's almost always a sign that the do-nothing rule should kick in. The more crowded the narrative, the more ruthless I become at asking, is this my setup, in my environment, on my terms? Even on a practical level, I've woven this into how I use my platform.
I set alerts not only for entry levels, but also for environmental conditions. If the index breaks a key support, volatility spikes, or leader starts to act like a laggard, that might be my cue to stop looking for new trades and move back to cash, even if I was in hunting mode an hour ago. The rule isn't just about days, it can apply to moments inside the day too. The interesting thing is that once you embrace this, the emotional weight of trading starts to shift. You don't wake up with the pressure to make today count in P&L terms. You wake up with the responsibility to make today count in discipline terms. If that means doing nothing, you can still go to bed knowing you did your job. And that opens the door to something very practical, turning all of this into a repeatable checklist. Not just a philosophy you remember occasionally, but a concrete step-by-step you walk through each session so that do nothing is an option coded right into your process, not something you only reach for when you're already exhausted. That's where we'll go next. From mindset to a structured routine you can actually run.
By this point, trade less and do nothing in bad conditions isn't a slogan anymore. It's a different way of being in front of the screen. But if it stays abstract, the old habits will win. I had to turn it into something mechanical, a routine I could run even on days when my emotions wanted the opposite. Here's how that looks for me, step by step. I start before the open, and I start wide. I'm not allowed to look at individual setups first. I force myself to answer one question: what kind of market am I in today? I pull up the higher time frames on the major indices, daily and 4-hour. I'm looking for simple things. Are we in a clear uptrend, clear downtrend, or overlapping chop? Our close is strong or weak relative to the day's range. Are last week's breakouts extending or failing? From that, I give the market a label for the day: forgiving, neutral, or ruthless. Forgiving means trends are respecting levels, leaders are extending, pullbacks are getting bought. Neutral is mixed action, some trends working, some choppiness. You can trade, but must be selective. Ruthless is fake-outs everywhere, gaps and reversals, no sustained leadership. This label isn't cosmetic. It controls my permissions. On a ruthless day, my maximum number of trades and my maximum size per trade automatically drop, and there's a very real chance my best move is 0 new positions. On a forgiving day, the do-nothing rule relaxes because the tape itself is saying, this is when your style works. Next, I go to my watch list. These are names I've already tagged as potential leaders: strong relative strength, clean structure, real volume. I scan through them with one question in mind: is anything truly ready, or are things still forming? If nothing is at or near a proper base, breakout level, or support zone, that's my first big green light to consider doing nothing. If everything is mid-range, extended, or sloppy, I make a note, no A setups on watch list. I actually write that down. It sounds trivial, but it stops me later from pretending something was A+ when it wasn't. Then I draw my lines. For each interesting name, I mark the key support I'd be willing to buy against, the resistance or base high that would define a breakout, the level where, if price chopped through repeatedly, I'd consider the setup invalid for now. I set alerts at those levels and step back. This is important. Until an alert fires, I'm not hunting, I'm observing. The do-nothing default stays in place. Just because I have levels doesn't mean the market has agreed to play ball. When an alert goes off and price reaches one of my areas, only then do I ask, does today's market label
forgiving, neutral, or ruthless, support taking this kind of trade? Is this stock still acting like a leader today, or has it weakened relative to others? Is the move into my level orderly and constructive, or is it a chaotic spike? If any of those answers are wrong, the do-nothing rule wins. I cancel the idea, even if the technical pattern looks nice on a static chart. If all those answers are right, I still don't have a trade. I need a reason to act now. That might be a clear breakout through my level with volume, a rejection at support with a tight risk line, or a reclaim of a key level after a shakeout. Only when I see the tape behaving in line with my plan do I move to position sizing. At that point, the rest is more conventional. I define my stop where the idea is clearly wrong, size the position based on a fixed risk percentage, and pre-commit to exit if the stop is hit, no questions asked. The part that's different now is that I've passed through multiple checkpoints where do nothing was the default and a trade was something to be earned. Finally, at the end of the day, I do a short review that's centered around this rule. I don't just ask, were my trades good? I ask, did I take any trades that my market label said I shouldn't? Did I open a position that wasn't near a pre-marked level just because I was bored? Did I stick to my maximum trades and size limits for the environment? If I broke those, I log it plainly. Violated do nothing, forced action in bad tape. Seeing that written down a few times in a month is usually enough to sting me back into discipline. Over time, this routine turns do nothing into a living part of the process. It's not about heroic self-control at random moments. It's about building a path where doing nothing is the natural outcome on most days, and trading is reserved for the few sessions when the market, your watch list, and your rules all say, now.
By the time this routine became a habit and not just a theory, I noticed something strange in my P&L and, more importantly, in my head. There weren't as many fireworks, fewer huge days, fewer wild swings, fewer stories that start with, "You won't believe what happened." But there were also fewer nights staring at the ceiling, replaying a stupid trade I knew I had no business taking. Fewer mornings trying to trade my way out of a hole I dug in a bad tape. Fewer moments where I felt like the market and I were locked in some personal battle I had to win today. The do-nothing rule had done exactly what Livermore needed it to do. It lowered the temperature of my entire trading life so that I could actually hear my own process over the noise. Looking back, the arc is clear. I started where most traders start, believing that more trades meant more opportunity, that flat meant failure, that doing nothing was the same as being left behind. That belief fed the paradox. I wanted discipline, but I also wanted constant action. I wanted big results, but I couldn't stand the quiet that those results require. That's what pushed me into the trap, the slow creep from A-plus setups to good enough, from I'll rate to I'll just do something, from careful risk to emotional volume. The market didn't have to beat me with one punch. It just let me swing at shadows until I punched myself out. In Livermore's life, that cycle played out on a massive scale. He made and lost fortunes not because he didn't understand markets, but because he sometimes refused to accept that his best move was to step aside. When he finally did accept it, really accept it, his whole framework shifted. Cash became a strategy, not an embarrassment. Waiting became part of the campaign, not an interruption of it. That's the essence of this rule. It's a vote for sequence over impulse, a recognition that markets move in seasons and your edge doesn't exist in all of them. The operator in you knows this. The gambler in you pretends not to. When I started to treat do nothing as a first-class action, the shape of my trading changed. My worst weeks became less frequent and less deep because I wasn't trying to force edges out of chaos. My best trades started further back in time, in the weeks where I'd preserved capital and focus instead of bleeding them away on boredom trades. My sense of self-worth detached a little from did I make money today and attached more to did I respect my conditions today. It doesn't make the itch disappear. There are still days when the old wiring lights up, when a moving name, a hot narrative, or a slow month makes me want to override everything and just do something. The difference now is that I can see that urge as part of the landscape, not as a command. That's what stepping into Livermore's mindset really gives you. Not omniscience, not some mystical feel. Just the ability to say, with increasing calm, "This is not my market today. I'm allowed to stand aside." And then actually stand aside. If you think about your future as a trader, not over the next week, but over the next 5 or 10 years, the most important decisions you make won't be the handful of spectacular entries you nail. They'll be all the days you quietly refused to gamble in the wrong conditions. All the afternoons you closed the platform, still flat, and chose to let the market be messy without dragging you into it. Those days never show up in a screenshot. They don't get likes. They don't become legends. But they are the foundation under every account that survives long enough to see compounding work. And that's where this story really lands. Livermore didn't get rich because he was always in the market. He got rich when he finally accepted that his talent was wasted if he spent it fighting bad tape. His wealth, when it came, was concentrated in a surprisingly small number of campaigns. The rest of the time, he was doing exactly what this rule asks you to learn to do: watching, studying, and waiting for his moment. You and I don't have to recreate his life, or his bets, or his era. But we can borrow this one piece of wiring from inside his mind. Activity is not the same as progress. Flat is not the same as failure. Sometimes the highest form of trading is choosing not to trade at all. If you can carry that with you to the next choppy week, the next sideways month, the next noisy morning where everything looks tempting and nothing is aligned, then the do-nothing rule has already started doing its real work, not just protecting your capital, but reshaping the kind of trader you're becoming every time you sit down in front of the screen.